Hello everybody and welcome to the Cyclical Investors Club YouTube channel. My name is Corey Kramer. Today we're going to be taking a look at EPAM systems, ticker EPAM. This one came in by request down in the comment section of one of my other videos. If you have a request you would like me to analyze, just put it down in the comments. If it's a stock that's in the S&P 500, which I think EPAM is, I post those on YouTube for free, and the rest I post over on Patreon. And there's a free tier over on Patreon now too. So I say if you get a chance, consider joining that. And then you won't have to rely on the YouTube algorithm to put me in front of you. I make probably about 5 videos a week now that we're into the summer. And I do take requests. If you join the $5 tier over at Patreon, you can request stocks that aren't in the S&P 500, and you also get a big discount if you ever decide to join the full Cyclical Investors Club service over on Seeking Alpha. And I'll have all those links down in the description. I'll also have a link for a 25% off for Fast Graphs, which I'm going to use in this video, which I usually use. It's an affiliate link, so if you think Fast Graphs looks pretty useful, you can consider checking that out as well. All right. As always, this is not individual investing advice. This is just how I analyze stocks. And EPAM's pretty interesting. I started tracking it somewhere during this giant run-up because they had really good growth, and I was tracking it as a growth stock. So I have a strategy that's just for growth stocks. Especially I try to get kind of the earlier stage ones, but sometimes the bigger ones will fit as well. In the full Cyclical Investors Club service, I don't really share that strategy, the details of that strategy, on the YouTube channel, but I started tracking it using that strategy because it had really solid growth. It didn't have data from a recession, which is usually what I want for the normal earnings-based kind of, I call it the full cycle strategy that I use, that you see me use here a lot on the channel. Of course, now it's been so long. I mean, if you don't count the 2020 recession, you can see the little gray area here that was sort of a recession. It was pretty unique because of the pandemic. It's been 15 years since the U.S. has had a recession. So I kind of have to make some adjustments now and just accept that I'm not going to get the recession data that I really would prefer to have on a lot of stocks. But these guys have been around for publicly traded for 12 years now. So there is some relatively long-term data. But this is ultimately going to be a stock where I just have to use some judgment, just what I think makes sense. I no longer track it as a fast growth stock because these past couple years growth has been negative, and I'm not sure that they'll be able to kind of pick up the trend that they previously had. But I didn't buy it during this big giant upcycle. I think at first it just wasn't cheap enough, and then by the time that this decline happened, this was basically around the time Russia was invading Ukraine. EPAM has a lot of employees and workers that were in Ukraine, and so that initially kind of hurt them. And then I think this was kind of a pandemic boom to some degree, and so now we're having kind of the bust of that again to some degree. So they've had some challenges, generally speaking. Probably more so than other companies because of the Russia-Ukraine war. So, all that said, lately, when it comes to IT and consulting businesses, I've pretty much been avoiding them. Typically what I do is I go and I look how many employees they have relative to the size. And if it's 30,000, 40,000, if the employees are really high relative to the size of the business, typically I just avoid them. I haven't had great luck with these business. I owned Cognizant for a while, which is maybe what I saw one other analyst use it as a comp. I didn't do very well with it, and I eventually sold it. I don't know if I actually lost money. I might have made a little bit of money, but it wasn't a good investment. We can take a look at that actually. Just I'll show you the pattern I was looking at there. This has been a while ago. It was pre-pandemic, I think, probably 2019-ish, like right in here. So they had this huge, really long history. Look how beautiful this earnings growth was. And then it looked like they were going to have a down year, and the stock price sold off. And I thought, hey, they have a good history. Maybe there's a chance they'll bounce back. I think I bought it maybe when it was like 30% off its highs. So I bought it right in here. And then basically they had now at the time I thought they would just recover, but we had the pandemic, and then they had another year where earnings continued to fall. I think they replaced the CEO, and then they tried to have like a comeback. But really, I mean, the stock hasn't really gone anywhere for 5 years now. So I sold it at some point in here. I don't remember exactly where it was, but that was kind of the setup. So this is one of those cases where history didn't continue. They stopped. They weren't able to keep growing at the same rate that they were before. So I kind of point that out because, see if I can get back to our target stock here. Because even though we have this really solid history leading into the last couple years, and we kind of have some reasons why we might be seeing the growth decline these couple years, we just have to keep in mind that these things don't grow forever at a certain rate, especially with consulting. But what I do like about EPAM in particular is they're more like software engineering type consulting, it seems like to me. And so I think that demand could pick up again at some point. But I don't really know. Like, I don't really have like a super strong opinion, but I would say I do track them. I would consider buying them at the right price, which is pretty different than almost every other consulting business out there right now. So if I look and I see a business has like, I don't know, people ask me about them quite a bit, and a lot of times I'll look and it'll be like a less than $10 billion business, and they have like 60,000 employees. Usually a lot of them are in, India or some other place. And with AI and everything developing really quickly, a lot of those stocks have sold off. I don't think I can tell whether those sell-offs are justified or not. And it's just hard to predict what that kind of future is going to be. And so my inclination is just not to buy any, basically. So this might be the only one that I would consider buying that I've like looked at. So that kind of says like something, I guess. I don't know. It doesn't mean I'll be right, but I think it's solid. It appears solid enough. And this sell-off, one, it was just really overvalued. It was kind of ridiculously overvalued. We see this a lot. So the sell-off is quite deep. I don't think that's reflective of the actual business necessarily. I think a lot of this is explained by Ukraine and the post-pandemic bust. So basically what I've done is I've said, okay, what earnings growth rate, if we look at what they've done through this year on the fast graph, just basic from 2012, it's like 18% earnings growth. The analysts think after this year they can grow at 18% earnings growth. So I don't know if they're just throwing that number out there, what they're thinking, but you can see it here, 17 and then 19. I'm just using 10% for now, but there is one kind of important caveat that I'll get to. But really what I'm thinking is, if the valuation looks good with a 10% earnings growth based on forward earnings, and it looks like a bottom is basically formed and the momentum is positive in the stock again, if those two factors occur at the same time, I would consider buying it. Okay, so that's my thought process here. I usually take like 1% weighted position, so it's not like I'm going heavily into it. It's just kind of a bet that I would be placing on this particular idea in an area I don't really have any specific exposure at all to consulting. So let's look at the value. Okay. So you can see I have potential oddball because this isn't really going to follow like any particular normal process that I have. I used to track it as a growth stock, but now that growth has kind of gone away, and they're going through the kind of this period of it's kind of down period basically, which isn't huge. I mean, earnings have only fallen a couple percent each of those years, but I'm going to assume earnings grow at 10% once whatever we get to the bottom. And right now they're expected to earn $10.18 a share this year. So they do have some cash, I think. So I'm actually usually I am treating the stock price with companies that have debt, like net debt, higher than they are. In this case, I'm going to actually treat it lower. So it's about $30 lower. And so that 24 PE is actually going to be a little bit lower. When I convert that to an earnings yield with the debt adjustment or cash adjustment in this case, I get a 4.66% earnings yield. So if I bought the business for $100 and I took into account the net cash that they have, I should earn $4.66 this first year. And then I assume that will grow 10% and I pull the first year forward. So that's up to $5.13. Really what I know is if that grows each year, that $5.13 keeps growing at 10%. On my $100 investment, how much money would I collect after 10 years? So on my $100 investment, I make about $82. If you put that into a CAGR calculator, so you start with 100, you end with 181.76. After 10 years, it should give you a CAGR somewhere close to the 6.16%. That's about fair value if you assume eventually after this year they start growing at 10%. I would want this to be above 8% before I would consider buying it. I don't think I have a buy price on this one. I can give you this is probably going to change because I think their earnings will fluctuate. But I can give you just a rough estimate here. I'm going to say, I can test a couple. Oh my gosh, first try at $175 per share is where it would cross the valuation level that I want. So I want to buy it under 175, assuming earnings come in at 10.18. If they come in higher, that would go up, right? The other thing I want is momentum to be positive. Right now it's at a C, which is a -1. It would have to go up this is a momentum score from Seeking Alpha. You can use like a moving average or, any kind of other technical analysis, but you really want the momentum of the stock to be positive after and have it also be under 175. Or close to it at least. So the stock needs to fall more. I don't know how many percent more, like 7. I'm not going to be able to do that in my head probably, but down to 175 or below, and then kind of form a bottom and start to come back up. And at that point, I would consider taking a position. I wouldn't say I would have like a ton of confidence in the position, honestly, but it's one of those where you're just kind of playing the odds. And if they work out, and if they actually end up growing earnings at 17 or 19%, then you'll do really well. And I don't think anybody knows if that's going to happen or not. So you just kind of have to say, okay, well, they've done a good job up until all these problems happened. And if, things kind of straighten out and they get things figured out, demand for their business rises, they make adjustments and all those things, there's a way that it could work out. And if you're buying at a reasonable valuation, so I don't know if they've been down maybe here. Yeah, even back here, they weren't quite down there yet. So it would probably be under a 20 PE, probably closer to like a 17 or 18 PE, I'm going to say maybe, without actually doing the math. So, for a stock that has growth potential, we've seen that even though this is kind of a crazy upcycle, we've seen that it can grow that fast. When they earned $5 a share, they traded at 228. So, you know, obviously if they're earning twice that at some point, maybe, you know, you could expect that it could go there again. So if you're buying cheaper than that. So I do think I would have a margin of safety built in, but I don't have any like special information on like the business or advantages they might have. Or I mean, I just don't. That's why I take small positions. I basically just try to, in situations like this where I can't rely too much on the history other than to look that they were growing pretty well in the past. I just have to kind of play the odds. So that would be my approach with EPAM. That's what I think of it. If you found this useful, hit the subscribe button, hit the like button. If you have a request, put it in the comments, and I'll see everybody later. Bye.